Hey everyone, Cal Doggett here, founder of Investor Code. And in this video, I'm going to show you how you can essentially take care of 90% of your due diligence with two major questions. This is tried and tested. I've done this on every asset I've bought, and these two questions will hold you in incredible stead. So what we'll do is we'll head to the PowerPoint slide and get going. So if I could do one thing in my due diligence, I would ask these two questions. I'm going to show you that now. What I'll cover, the due diligence framework itself. So what does make part of my due diligence framework and how do I go about due diligence on an asset? The two fundamental questions that you need to ask. And then if you ask those questions, well, it's only as good as the answers you're going to get. So where can you look? Where can you go? How can you get the answers that you need in order to satisfy yourself of the property you're about to acquire? And remember, the framework here is about saying no to 999 out of 1,000 properties. So you've got to get in the habit of really interrogating information and being comfortable walking away if you're not completely comfortable. That's how I have never lost a dollar in this game and why my returns speak for themselves. So why listen to me? I've got 20 years of commercial property investing experience across Australia, every state in Australia. I have well over $500 million worth of transactions under my belt. That's buying, leasing, managing, selling. I've got well over 100 plus leasing deals now. It's probably closer to 200. I should really update the slide. And the leasing deals is where a lot of value can be added in property. And it also shows an ability to buy assets that are going to attract the next tenant. So it's really difficult to do leasing deals if the underlying property isn't actually going to attract the next tenant. So they go hand in hand. On my syndicated properties, I've generated a return on average of 21% per year, which is pretty remarkable. But what I'm more proud about is that I've got countless examples now with my private clients and personally with my own funds of generating well over 100% returns in properties that I've acquired and sold. So I'm here to teach people how to do that. Investor Code is here to do exactly that. So with that being said, guys, please subscribe and follow if you like this content, comment, and you can find all of my information, all of my collateral, and my online course at investorcode.com.au. Okay, so I cover this every time because this is my ethos for how to make money out of property. And it's 6 simple steps. This is going to take 20 seconds. These are the things you have to do. You've got to find, source, locate a property, run your feasibility, then you go ahead and contract and secure it. Don't get those two mixed up, okay? You want to do your feasibility first before you go spending all your time and energy and effort and cost on your lawyers before you contract it. Then you do your due diligence and secure your finance. And that's such an important part. That's what I'm going to cover today. Then during your due diligence, you will uncover problems and risks as well as opportunities. So step 5 is then using those problems to generate uplift and manipulating the value of the asset, and in a lot of cases, manipulating the yield of the asset. And then you can decide to hold or sell. And if you do this well, you can generate astronomical money out of commercial property. Okay, so on to what we're about to cover today, guys. The due diligence framework. And look, due diligence, how long is a piece of string? You can really spend a lifetime in due diligence. But if you look at the things that actually drive the most value, like the most bang for your buck, if you've only got 2 days to do due diligence instead of 30, how are you going to go about doing that? And I wanted to empower you guys to think about that, which is why I've gone through this framework. So you want to know 3 major things. Firstly, you want to know about the property, the premises, and location. And I put those 3 together because the property is, we use the word, I'm going to buy that property. But really what we're talking about is a premises, which is 4 walls and a roof, and sometimes a few other bits and pieces. Maybe there's some cold storage, or there's a veranda, or there's something underground, or there might be fuel tanks underground if it's a petrol station. And the location. Now the location you cannot change once you buy it. So they go hand in hand, guys. You need to understand the location of that property, as in, is it in an industrial precinct or a retail precinct? Is it on a corner site, or is it hard to access? Is it on 100 square meters or 1,000 square meters or 100,000 square meters? These are all things you need to know when you're buying a property. You need to know the inherent land that it sits on, and then you need to know the integrity of the four walls and the roof and the actual, I suppose, the fabric, they often call it, and how that's going to go over time. So with a little bit more detail here, you really want to understand the structural integrity of the building. So that's like, and you can get a tech due diligence to help you with this, okay? They come in, it's about $7.5 grand. They'll crawl all over your building for a day. They get on the roof, they look at the air cons, they look at your fire services, if it's sprinklered, is there the right fire hose reels in the right spot? Is it compliant with all of the standards? Are your doorways the right width? Have you got an ambulatory toilet? Is it universally accessible? All these things I'll cover off for you. And they'll let you know also the integrity. So they'll say things like, okay, your aircon's 20 years old, it's going to need replacement. Hey, there's some floorboarding that's coming up in the kitchen because there's a water leak, or there's some rising damp in the warehouse, or you need to know that wall looks like a permanent wall, but it's actually not, or hey, there's a load-bearing wall over here that needs some work. They'll tell you everything in a tech due diligence report, and that's really important to understand what you're buying, because once you've got it, guys, now it's yours for forever until you sell it. And if it was problems buying it, you need to fix the problem before you try and sell it, okay? So you want to be careful about what you're inheriting, and due diligence is your chance to be careful, all right? You want to understand any risks with the land. Now, risks also go hand in hand with opportunities. So for instance, you might look at the land and go, oh my gosh, this is contaminated. Or you might do a detailed property report and it might show there's a flight path over it, or that there's cables running under the ground. Or the council might have a reservation over some of your land to widen the road. All these things run with the land, and you need to understand these. The other thing that might happen is you might look at it and go, wow, this is actually used for industrial, but this is zoned. It's a zoning change is coming through which will make it retail. All of a sudden, the rent that you're receiving at $150 a square meter could go to $300 a square meter. So it's not all bad. It's about gathering information, and the more information you can gather and then assimilate, the better decision making you have. Third thing you want to do, as I covered off, is the zoning and changes in the area. And look, it's not hard to find this stuff. You go to the council website, let's say it's in the city of Bayswater, you go to the Bayswater City Council, you look at the zoning map, it'll tell you that property is within this area is zoned X or it's zoned Y. These are the usages. It'll literally tell you like point form what the usages are, what it's allowed for, what it's not allowed for, and then it'll tell you, often there's a map of saying, this is our 20-year plan, how we're re-envisaging the city of Bayswater, and you'll be able to get a lot of information from that one report. And look, with AI these days, you can grab that report, chuck it in AI and say, give me a summary that I can read in 5 minutes, and it'll basically tell you, hey, they're looking to create more public space, or they're looking to resume some land to widen the road, and all these things will really impact your due diligence on a property. The next thing you want to know is your tenant and your lease, okay? And they go hand in hand again, because if it's vacant, obviously there's no lease in place. But if there is tenanted, then there must be a lease in place. And if there's not, that's a red flag, okay? There's some things you want to understand here, and one of them is a lease review. And it's important that you use professionals to do that for you, but I would only do that after you actually take a page turn yourself. It's incredible how much of a lease is actually pretty straightforward language. Yes, it can be long sentences and there's different clauses, but if you actually spend the time to read the clause, you can actually get your head around what's trying to be conveyed with the lease. So I often do a lease review myself, or I get my team to do my lease review, and only then do I ask my lawyer to review it. And sometimes you ask the lawyer to review it and they've missed something. So it's really good to do that yourself. What you want to look for is the agreement that is written and executed, firstly, is it executed, and is it executed correctly and by the people that are supposed to execute it? And then is it actually what's happening? There's so many times, guys, we buy a property and we're like, oh, they started on a rent of $100,000 a year and it's escalating its CPI for the next 5 years, and we're in year 3 and we're looking at the rent and we're like, wow, they have incorrectly escalated the rent last year. They didn't use CPI, they used 2.5% and CPI was 2.7%. Bonus, more money for us. So it's really important that you actually take a lease from when it started and then go, okay, what happened to this lease? Was it varied? Is it still in place? Did it start 20 years ago and now there's been 15 variations? And I know that might sound complex, but all you need to do is cut aside 2 or 3 hours of your time and just follow the course of action which has led to the agreement that currently sits in place with you and the tenant. And then you want to understand, is that currently being reflected in how they're operating? And that's where you go, okay, well, are they actually paying the rent they're supposed to pay? It might say that there's 1,000 square meter premises. All right, well, is it 1,000 square meters? Do you want to get a survey and make sure that it's actually 1,000 square meters? Maybe it's 1,050. All of a sudden you gain 50 square meters. Often we'll get a leasing survey and we'll look at it and we'll go, oh wow, there's a mezzanine here. No one told us about the mezzanine. Or it might say things like, the tenant owns all of the fit out. And you're like, whoa, there might be cold storage in there, or there might be incredible lighting and amazing floor coverings, and all of it is owned by the tenant. And it'll tell you that in the lease, guys. So it's really important to do a lease review. Do your own one first, and then use a solicitor, okay? Second thing is tenant review, right? And that's where I kind of mentioned, like, you want to make sure that the tenant that's currently paying your rent, firstly, are they articulating their business in a way that is aligned with the lease? Secondly, you want to know, are they going to stand the test of time? So, firstly, you want to kind of back the right tenants here if you want to keep the tenant. But if you want to remove the tenant, well, then who cares? So things like, okay, well, what area are they trading in? Like, if there's a tenant making spare parts for Rubik's Cubes, is that the kind of tenant that's going to pay the bills over the next 10 years? Or if it's, a tenant that's got, they're doing data storage. It's like, oh, wow, data storage is in demand right now. Or maybe it's a tenant that is doing a retail trade and, there's a lot of online headwinds which are coming into the retail space. So you don't need to be an expert to figure this out. It's more about human nature here. It's more about looking at that tenant and going, can I see that tenant, the usage for them, the need for them continuing today and tomorrow, and at least during their lease term, okay? Then you want to ask more questions about what happens when their lease expires. If you can, you ask the tenant for their performance history, and sometimes it dictates that in the lease. Like the tenant has to supply their performance, which means they have to supply financial accounts at the end of every month or end of every quarter or end of every year. That's incredible information, and no one spends the time to go through that. And if you go through it, it tells an amazing story. Sometimes you hear about these tenants that have incredible revenues and like zero profitability. And you're like, wow, is that the kind of tenant I want to back right now? Or, it might say that you might hear these things anecdotally, like Bedshed's doing really great this year, or, Pillow Talk's doing amazing this year. They're producing these huge profits. And then you look at the balance sheet, you're like, wow, the owners are stripping out those profits. Like, so are they spending money on marketing? Are they not spending money on marketing? Is this particular store doing as well as the national average or not? All these questions really come up during your due diligence period, and it's just a case of following the bouncing ball, right? So you ask one question, that might bring up another question. Okay, keep going. Cut aside some time, don't get distracted, and give yourself the opportunity to look at why you shouldn't buy this premises. Get all your problems, put them all in a list, and then you can start answering them, saying, cool, is there a solution for that? Is there an opportunity there? Am I looking at that the correct way? Should I go get advice on that? All right, market is the third thing, and this is a broader way of looking at a property. You want to look at how it sits in the local, national, and global framework, right? So right now, for instance, let's just say there's retail, there's industrial, there's office, okay? Now we know that office got smashed during COVID. So right now, if you were going to go buy an office building during COVID, would you say that the national and global landscape was good or bad? You'd probably say it was pretty risky. Like, who knows if people were going to return to work, how much of it they were going to return to work. Is it going to be 10%, 20%? If they don't return to work, are people going to even need offices in the future? So all of those questions were coming up during COVID, which is a good example of a national or global happening or event which is actually impacting property values. The other thing you want to understand is the local market. It's really important because different suburbs and different premises and different locations and even different pockets of suburbs have different innate values because of human nature. So for instance, if I want to be an industrial premises and I need to be really close to the airport, obviously, if I'm in Welshpool, I'm far closer to the airport than if I'm in Gidgegannup. So it's, those are really, I suppose I'm dumbing that down a little bit, but that's the kind of way you want to look at your market. What is this property doing in relation to the market around it? And then are there any more national or global things happening which could impact it? So for instance, if you know that there's a huge amount of electric vehicles coming on the market and petrol stations are a bit of a worry, would you go out and buy petrol stations? Maybe not. So it's a really good example of like a national or global happening, a change in the way that humans interact with technology and property. How does that play a part for this particular asset? And then you want to hone your focus in on, okay, what's the local market doing? Is this corner better than that corner? When people drive down this road, can you see the premises, or is there a massive tree in the way that you can't cut down? All those things will impact your ability to lease it in the future. So that's a very, very broad brushstroke due diligence framework, guys. And I cover all this in my online course. There is a lot more where this came from, but this is the snapshot, okay? What I want to show you now is how you can cover just about all of this with two major questions, all right? The last thing I wanted to say, there was passing versus market rent. It's really important, sorry. That is so important. One of the things you definitely need to understand is the rent that's currently being paid lower or higher than the market rent, which means the rent that an equivalent or comparable premises would be demanding on the open market. And you can get that information from a valuer or a leasing agent. Just be careful with the leasing agent. They can be pretty optimistic. So just peel back some of the information you get. But there are actually fantastic agents out there. There's a huge amount of information available online for free. If you subscribe to CBRE or Savills or Burgess Rawson or Knight Frank or Cushman & Wakefield, they give you reports on what's market rent looking like in all these different suburbs. They just publish reports every quarter. It's incredible the information you can gather from free reports. So you want to make sure that you've checked your passing rent, which is the rent that you're currently experiencing from the tenant, and how does it compare to market? Is it below or above market? And that will tell you whether there's an inherent value in the premises or an inherent risk when it comes to leasing it. Okay, as I said, a lot of that can be condensed into two questions, which will cover 90% of your due diligence. Here they are. Ask yourself these questions, all right? If I lose this tenant now, you could also put there, if the premises is vacant now, right? How quickly will I find a replacement tenant, and what protection do I have from this eventuality? So what we're saying there is, let's say you've got a tenant in place, they've got 5 years left on the lease, but something happens and they leave tomorrow. How quickly will I find a replacement, and what protection do I have from this eventuality? So things like, is it going to take me 3 months, 6 months, 12 months, 24 months, 36 months to find a tenant, right? It's a really interesting thing to note. If I find that tenant, are they going to pay above market or below market rent? Am I going to get a better tenant or a worse tenant? All these things, it's really great to ask yourself when they're all included in that one question. Second question, if I lose this tenant when their lease expires, how quickly will I find a new tenant, and will the asset be more or less valuable? So that's another way of looking at a similar problem. I'm saying, let's say you do have 5 years left on the lease. If the tenant in 5 years' time said, hey, I'm out of here, I want to move on, how quickly will you find a new tenant? Okay, so you've got to ask similar questions. Would you need to do a leasing campaign? Would you have tenants knocking down your door to get into the premises? Or would you sit there for 6 months waiting for a tenant? Would you sit there for 3 years? There's some premises that you know of when you'll walk past them when you're going to the shops and you're like, I've seen 8 different operators in that one premises in the last 8 years. It's a new operator every year, okay? So you've got to think, if you're the landlord of that property and you're paying leasing fees every time and you're paying incentives every time and your tenant's going bust every time, maybe there's something wrong with the property, right? That's kind of the way I want you thinking about this. Is like, if you lose your tenant, will you find a tenant? That's the first question. How quickly will you find them? And will they be better or worse? And then lastly, will the rent be better or worse? Which was that what I showed you on the slide prior. Is the market rent higher or lower than the current passing rent? Interestingly, I'm going to take one more deep dive here. If you ask yourself these two questions, this is what happens. You will uncover the vacancy rate in the area. Now, there are streets in Australia where you could lose a tenant and you would have 4 people apply for that tenancy the next day, okay? Which means that the vacancy rate is next to nothing. Like for instance, Napoleon Street here in WA, if you lost a tenant, a retail tenant there, you'll have 5 applicants for a new retail tenant within a week of putting up a marketing or advertisement, okay? So great property to own. As a result of that, you're going to pay a very high price for it, okay? And then, there's examples of that in Melbourne, some of the strip retail there, or there's malls that have this, right? Where they just go, wow, that's irreplaceable real estate. It's always going to have a tenant. But there are some properties where you might lose the tenant and there might be vacancy everywhere. Like you might look to the left and to the right and across the road and next door and 5 doors down and you're like, oh, there's a vacancy. Oh my God, there's another vacancy. Oh, there's another vacancy. And they're all the same size as mine. So that's really important to understand, like your competition is other premises that's available for lease, okay? So you need to know what the vacancy rate is in the area. Again, you can get that from an online free report. Like you just go Cushman & Wakefield or cbre.com. I want to know vacancy rates in the area and I'll give you a report every quarter. It's incredible. So if you ask these 2 questions, these are the things you'll uncover. Vacancy rate in the area. You'll also uncover the likely rental downtime. They might tell you that you could expect to lease a premises within 6 months, or maybe it might take you 12 months. Now you've got to think, if you're buying a premises and it's vacant for 12 months, you're still paying land tax, you're still paying rates, you're still paying electricity to keep the air cons running, you're still paying for security if you need to, you're still paying for property management. Those are costs you're bleeding, right? So you want to try and minimize your rental downtime. The likely incentive required to attract a new tenant. So, in the area, if you know that in Melbourne right now, in the office in Melbourne, they're offering like 75% incentives, sometimes 100% incentives for tenants to take occupancy. If you go buy a premises in Melbourne with your eyes closed, that's what you're going to experience. So you're going to lose your tenant, and what happens next? You're going to have to give it away for free. Whereas, if you've got a retail showroom in Osborne Park where they're very low vacancy rates and a fantastic area to be in, maybe there's only a 5 to 10% incentive required to attract a new tenant, maybe no incentive. So all these things is kind of a way of looking at it and saying, again, there's 2 big questions. What happens if I lost a tenant? How long would it take to fill that space? And would I get a better tenant or a worse tenant? These are the questions. And underneath those 2 questions are all these little ones. The marketing agency costs of releasing. This is very simple, guys. You can literally type this into AI. Hey, if I've got a retail, if I've got an office, or I've got industrial, or I've got a childcare, you just go, how much does it cost to lease a childcare centre? And it'll just spit it out, 15 to 22%. Great. And you can actually add that in as a cost and go, cool, well, now I know that if I lost the tenant, that's what it's going to cost me to get a new one. In order to get a leasing agent on the job, is there marketing that I'm going to have to spend? I have to put a billboard up the front. Do I want the marketing to be online, or is it not going to be online? Am I going to have to pay for Meta ads or Instagram ads? You can ask all these questions before you own a property, and I strongly advise you to do that because it's just great information that allows you to make gorgeous decisions. The likely make good of a premises, and we see this so often, guys. People go buy a property, they're like, oh my God, it's producing an 11% return. And we go, oh boy, okay, please show me the lease. And all of a sudden it's like, yeah, the tenant's paying way over market in rent. They've got 18 months left on the lease and they have no make good. And then you look at the premises and you're like, oh, there's asbestos everywhere. There's no ceiling. The roof's falling apart. The tenant may have been using it for an industrial facility, and there's, the slabs are widening. There's cracks in the wall, and you're like, you're going to have to spend all this money to make good your premises because the tenant's not going to make it good. They're just leaving. You're going to have to make good your premises in order to get the next tenant. Vice versa, you might have a really great lease in place where the tenant is required to make good everything. They might have to make good the ceiling, they might have to paint the walls, they might have to fix the glass, they might have to, give 2 coats of gorgeous Dulux paint on the outside, they might have to replace their signage, they might have to service the air conditioners and service the roller doors. All of that could be in a make good, in which case you're in a far better position to then lease that premises to the next person, and it's not costing you, it's costing the tenant. Any works required to bring the premises to standard. Now this is where that tech due diligence report comes in really handy, because they'll show you if you're non-compliant, which is okay sometimes. It depends when the building codes were formed and depends when the tenant took occupancy. They'll also tell you if you lost this tenant and you went to put a new tenant in place, the council's going to say, hey, you need to do X, Y, Z. Your toilets aren't big enough, your front doors not wide enough, there's no disabled access, there's only stairs, and they'll tell you all those things, and you can even then ask them, what would be the cost to rectify those things so that I could then get ready for the next tenant? Really, really important, guys. Or, there might be wider happenings in the market, right? So, you might look at, let's take industrial, for example, right? Now, industrial uses square meterage as I suppose a factor of rentalization, right? They use square meterage times by the amount of square meters there are, square meter rate, over the amount of square meters there are. But if you're a warehousing tenant for industrial, how high you can rack is hugely important, because if you've got 5 meter clearances, you can use 1,000 square meters plus 5 meters up. But if you can use 1,000 square meters and go 10 meters high, well, you get double the amount of racking, right? So you get double the amount of yield out of that warehouse. So what I'm saying there is, like, if you've got a older industrial premises with really low roofs, you might struggle to get the next tenant because they want higher space. Or instead of getting a warehouse tenant, you might get a tenant that's more suited to fabrication, because they don't need to rack as high, but they need to do a messy, their operations are messy and they don't need a high ceiling. So all of that is like bleeding into what the market's actually wanting now. Like, what is a new tenant for this particular kind of property going to want to demand, and what can they get down the road? Because if they can get a better premises 2 doors down, well, why would they look at yours? Okay, so you need to understand the make good and the works required to bring your premises to standard. The process of securing a new tenant, right? So, like, how do you go about that? Is it just make a phone call to a leasing agent and put up a billboard? Or is it a lot more cumbersome than that? Do you need to go through a rezoning change, or do you need to go through redevelopment, or is the building going to be resumped? Is there, can you even lease it at all? Because there's caveats on it that you didn't see. All these things are going to impact the value of your premises long term. So you need to understand these things. And I'm giving you the questions right here, guys. Also, you want to understand the quality of the tenant you can expect. And this does come down to the demand for the area. So again, you want to look next door, you want to look across the road, you want to take a little Google Maps and say, hi, where are my competitors right now? And are they in better premises than mine or worse premises than mine? And you want to go onto realcommercial.com or realestate.com and go, hey, I'm currently buying a 1,000 square meter warehouse. Let's look at the amount of availability of 1,000 square meter warehouses in Wangara, right? Or I'm looking for a 250 meter retail showroom in Myrie, and I just want to see what availability there is for it for lease. Go on to realestateCommercial.com. Myrie, 250 square meters, available for lease now, and it'll just give you the options. And then you can actually say, is that option better or worse than mine? Is that option better or worse than mine? Why is that option better or worse than mine? And it just gives you a way of framing your property as a comparable to what's going on in the local market. It's really important, guys. The likely market rent you will achieve, and a lot of those areas, as in 1 to 8 there, they kind of impact number 9, right? Because if you've got a very high vacancy rate, well, obviously you're going to have to get a lower rent to attract a tenant. If you're needing to do huge amounts of make it to the premises, that might mean you can attract a higher market rent because the premises now looks gorgeous and it's better than the one next door. Or you might look at it and you say, okay, well, there's a massive new precinct coming in down the road that's being developed, and my lease expires in 2 years, and that's going to be ready in 18 months. Oh, that's a bit of a worry. All this supply coming online. So obviously market rents are going to come back. How long a term you can expect is important as well, right? So the term of a lease is genuinely regarded as the perpetuity of income that you can expect to receive, which is then capitalized to create value. So if you can have a 5-year lease to a good operator is less valuable than a 10-year lease to a good operator if the rents are the same. That's the general thesis. But what I wouldn't want is a 10-year lease to a very bad operator, because now the premises is locked up and you haven't got the right tenant for 10 years. So you need to understand how long term you can expect. And again, guys, that might be a phone call to a leasing agent or a few leasing agents. You could probably go online and ask for a couple of reports and you get an idea of the standard lease length. 5 years is a very common lease length. But if you're in, if you're in a medical right now, people take 10-year leases very easily. If you're in childcare, people take 15-year leases very easily. So it's about knowing what premises you're buying and how does that premises relate to the market going on around it. Okay, I've been talking a lot, so I'll just summate here what I covered, all right? The due diligence framework, guys. It's the property, premises, and location. It's the tenant and the lease, and it's the market, local, national, and global. Now you can cover 90% of that with 2 fundamental questions. If I lose this tenant now, how quickly will I find a replacement, and what protection do I have from this eventuality? And if I lose this tenant when their lease expires, or you could say, if the premises is vacant, how quickly will I find a new tenant, and will the asset be more or less valuable? And those 10 questions I had on the slide prior, they're going to give you the answers to these 2 questions, which is fantastic. Where to find the answers? Now, I've talked about this already, but you can go to valuers, you can go to tech due diligence specialists, you can go to lawyers, you can go to aircon. If you're looking at an aircon, you go to aircon specialist. If you're looking for, getting information on vacancy rates in retail, call up retail leasing agents. If you're in office, you call up office leasing agents. You might call up a specialist office valuer if you're looking at office, or if you're looking at childcare, call up the company that does the most childcare transactions. So you want to try and leverage the specialists you use to make sure that they are best in their field. But you'll find in the property game, people are very willing to give information, very willing to help you out, because that's how they're going to get their next commission. So please, guys, don't be scared to reach out to these guys, the valuers, the tech due diligence specialists, your lawyers and contractors. And in my online course, I give you all of the collateral that you would need to actually reach out. As I give you, this is the email you got to send the valuer. This is the phone call. These are the questions you have to ask your lawyer. This is the email prompt to engage a leasing agent. This is the prompt that I would use to engage my lawyer. Like, I literally give all of that to you in my online course. Now, I cover off at the end of all of these by saying that there is a formula to buying commercial property and creating X factor returns. You've got to focus on 3 key actions, right? And then you find the opportunities which allow you to make those 3 actions come to life. Do not do it the other way around, guys. You learn the essential things you need to know and do to secure opportunities, and then there's 3 things you got to do to de-risk them before you buy them. I cover all of that in my online course. This is one of them. Doing very good due diligence is one of them. So guys, if you like what I'm about here, please do subscribe and follow, or find me on investorcode.com.au. And thank you so much for watching this video.